All right, buying your first home is probably the biggest financial decision you've ever made. It's a huge, exciting milestone. But let's be totally real here. It's also super emotional, incredibly stressful, and packed with tight deadlines. If you're feeling a bit overwhelmed right now, trust me, you are absolutely not alone. Most buyer regret actually comes down to a handful of very predictable, completely avoidable blunders. So, in this explainer, we're going to break down 15 specific mortgage mistakes. By spotting these traps up front, you are going to save yourself thousands of dollars, dodge those awful late-night panic attacks, and honestly approach your whole home search exactly like a seasoned investor. Okay, let's dive into this and demystify the entire home buying journey. We're going to follow a predictable chronological roadmap here, conquering this in 4 phases: mastering your mortgage budget, securing pre-approval, making a smart offer, and finally, surviving the closing process. Phase 1, mastering your mortgage budget and avoiding those early financial traps. You see, the biggest financial traps actually spring on you before you even step foot inside an open house. Why? Well, mostly because lenders focus on the absolute maximum you can legally borrow, not what you can actually afford while, living your real life. And that leads us straight to mistake number 2, maxing out your budget. Look, spending every single dollar the bank offers leaves you absolutely zero breathing room. You still want to travel, right? You still want your gym membership and your morning coffee. To fix this, just stick to the 28% rule. The goal is to keep your total monthly housing payment at or below 28% of your gross monthly income. That leaves 72% for the rest of your actual life. And that brings us right to 36%, and mistake number 10, ignoring your debt-to-income ratio, or your DTI. Now, you might have a truly stellar credit score, but lenders are looking closely at how much of your monthly income is already eaten up by existing debt. Generally speaking, lenders prefer your back-end DTI, so that's all your current monthly debt payments plus your brand new mortgage, to be 36% or less of your total income. The absolute easiest way to fix a borderline ratio? Just pay down those small credit card balances before you even apply. It quickly lowers your DTI and can actually lock in a much better interest rate for you. Next up is exactly how buyers mishandle their hard-earned cash. Mistake number 4 is draining every single dollar you have just to make the down payment. I get it, it's super tempting to throw all your cash at the house to lower the loan amount, but doing this leaves you completely house poor. If the water heater unexpectedly bursts on day 3, you're going straight into credit card debt. The fix here? Always keep a 3 to 6 month emergency fund tucked away after you close. Then there's mistake number 5, the stubborn myth that you absolutely need 20% down. Guys, this myth keeps so many people renting for years. You can actually get a conventional loan for just 3% down, or an FHA loan for 3.5%. So don't let that 20% illusion hold you back. While we're still on the budget, we have to have a real talk about the hidden killers. This means tackling mistakes 3 and 11. Mistake number 3 is completely forgetting about closing costs. So many buyers diligently save up for their down payment, only to get totally blindsided by the fees for appraisals, title insurance, and taxes. Listen, you must budget an extra 2 to 5% of the home's purchase price just to legally close the deal. And then there's mistake number 11, underestimating the true cost of ownership. Your monthly mortgage payment is really just the starting line. You need to budget 1% to 2% of the home's total value every single year for maintenance. To put that into perspective, on a $400,000 home, you're looking at $4,000 to $8,000 annually just to keep the place running smoothly. Let's move to and see how this builds into phase 2, securing your pre-approval. This is the critical phase where you actually prove your financial standing to the sellers. And it brings up mistake number 1, house hunting before you get officially pre-approved. Look, I know it is so much fun to go look at houses, but falling head over heels for a home that you simply can't get a loan for is downright heartbreaking. A pre-qualification is really just a quick, unverified estimate based on whatever you tell the lender. But a pre-approval means the lender has actually pulled your credit and thoroughly verified your income. If you want a seller to take you seriously in a competitive market, they won't even glance at an offer backed by a measly pre-qualification. You absolutely need that pre-approval. Now, once you're ready to get that pre-approval, make sure you avoid mistake number 9, which is not shopping around for your mortgage rate. Taking the very first rate offer a lender slides across the desk can literally cost you tens of thousands of dollars over the lifespan of your loan. Rates and fees vary wildly from bank to bank, so here is your step-by-step fix. go out and get quotes from at least 3 different lenders. And here's the secret. If you do this within a 14 to 45-day window, the credit bureaus are actually smart enough to recognize that you're just rate shopping, and they'll safely group all of those pulls as one single credit inquiry. You protect your credit score, and you bag the absolute best deal. Phase 3, making a smart offer. This is where we avoid those dangerous emotional traps. High emotions, ticking deadline pressure, and crazy competitive bidding wars very often lead to the most catastrophic financial compromises. To keep your feet firmly on the ground, use a smart offer checklist to dodge mistakes 14 and 12. Mistake 14 is letting your emotions totally hijack your offer. It is way too easy to ignore glaring red flags and just overpay so you can win the house. Set your strict maximum price and establish your absolute deal breakers before you even tour the home, and stick to them. Then we have mistake number 12, which is forgetting that homeowners insurance can actually be incredibly hard to get these days. If you're buying in a high-risk zone for things like floods or wildfires, you must secure insurance quotes early, during your inspection period, because honestly, if you can't get the home insured, the bank is not going to give you the mortgage, period. So the crucial point is exactly how you handle your contingencies, which brings us to mistakes 7 and 8. Mistake 7 is skipping the home inspection just to make your offer look a little more attractive to the seller. Please do not do this. Waiving an inspection means you are risking inheriting a literal $30,000 foundation issue. Instead of waiving it, just shorten the inspection window so you remain legally protected but still look speedy. And mistake 8, carelessly waiving the appraisal contingency. If the house ends up appraising for lower than your offer, guess who has to cover that massive gap in pure cash? You do. The smart fix here is to use an appraisal gap clause in your contract, which strictly caps the maximum amount of extra cash you are willing to cough up. Finally, we reach phase 4, surviving the closing process and crossing that finish line. And this brilliantly illustrates what we call the danger zone. The finish line is completely in sight, but ironically, this is exactly where some of the most easily avoidable mistakes can completely derail your purchase at the literal last second. This timeline maps out the weeks between your offer getting accepted and the glorious day you finally get the keys. It feels like a boring waiting game, but behind the scenes, lenders are watching your every single move. Let's map out exactly where the final 3 critical pitfalls pop up. Mistake number 6 happens right smack in the middle of this waiting period: touching your credit. Let me be perfectly crystal clear about this. During the escrow period, you are in a complete financial freeze. Do not, under any circumstances, finance a brand new car to park in your brand new garage. Do not open a sparkly new store credit card to buy a couch for the living room. Heck, do not even close your old accounts. Why? Because lenders will absolutely recheck your credit right before handing over the keys. Any new debt instantly changes your debt-to-income ratio, and they will pull the plug on your entire loan just days before closing. It happens all the time. As you gear up to close, you've got to beware of mistake 13. Misunderstanding your escrow and future payment changes. A ton of first-time buyers assume that a fixed-rate mortgage means their monthly payment will literally never, ever change. Well, that is a huge myth. While your loan's actual interest rate stays exactly the same, your property taxes and your homeowner's insurance, which are almost always paid out of your escrow account, will almost certainly go up over time. You have to plan your budget expecting what we call escrow creep, where your total monthly payment inches up by maybe 5% to 10% every few years. Just bake it into your expectations. Now, what's really interesting about this slide is our final trap, mistake number 15, not actually reading your closing disclosure. By law, you're going to receive this 5-page document exactly 3 business days before you sit down to close. Because you are probably totally exhausted by this point, it is so tempting to just skim it and assume it's fine. But this is exactly where sneaky errors in fees, recording charges, or even interest rates like to hide. You absolutely must take this document and compare it line by line against your original loan estimate. If a fee magically jumped up or something looks even a little bit wrong, you have to ask your lender why before you sign a single piece of final paperwork. And there you have it. By simply dodging these 15 critical mistakes, you are putting yourself miles ahead of the average stressed-out homebuyer. You're approaching this whole massive transaction with discipline, foresight, and a true investor's mindset. But remember, the closing table isn't really the finish line, it's the starting block. Once you have those keys in hand, the next big question is how will you use that property to start building real generational wealth? So be sure to continue your financial journey with our Mortgage Intermediate Explainer. Keep learning, stay disciplined, and most importantly, enjoy your new home.